On behalf of all of us here at Beck Capital Management, we want to thank you for joining us for our virtual market update. We hope all of you are staying safe and healthy through the last 4 months of the COVID-19 shutdown. By now, we're all tired of hearing the words unprecedented and pandemic, but these are the times that we live in. With the pandemic comes a paradigm shift in behavior. As many of you are witnessing and likely participating in, we're seeing a shift to a more remote economy, a transition to a work from home, food to go, touchless curbside pickup type society. While our lives revolve around social interaction with friends, family, and colleagues, we strongly believe that portions of this new remote economy will last even once we return to normal, whatever new normal is. Today we're going to discuss our positioning in your portfolio to capitalize on this new remote economy, areas where we see lasting opportunities and areas that we're avoiding. Frank and Dr. Spellman are going to provide an update on the macroeconomic picture, and then Frank and Brian will talk more specifics about positioning of your portfolio. Thanks for watching.
The COVID pandemic has changed the landscape. It's not only resulted in loss of lives, but a lot of small businesses and jobs. Further exacerbating both of those is the riots and looters. But on the investment landscape, the damage was fast and furious, and since then we've been rebuilding at a pretty steady pace and are getting back to about where we were before the pandemic. Right now we're preparing for the election. It's going to be here in a few months, and there's a big difference in the two candidates. So right now, of course, since we have President Trump, we have a Trump-type portfolio. It assumes that we're not going to have new taxes. We have lower taxes and less regulation. We are also building a sample or getting ready for in case of a Biden presidency. We have a Biden portfolio which accommodates higher taxes and more regulation. It might focus more on clean energy and other aspects, and may even include more companies from other countries that are domiciled, perhaps in Ireland, where the income tax rate or corporate rate is very low, or maybe from some other countries. So it may be more worldwide or global in its focus.
Okay, as the macroeconomist at Beck, I provide inputs weekly on the overall economy. Frank likes to call it the 30,000-foot view, which indeed does trickle down and affect financial market pricing. And it generally, over time, basically the business cycle up and down gets reflected into financial market prices up and down. So we'd like to have that take to begin with. And usually you have a correspondence of the economy and financial markets. But then we got the pandemic, and that really severed the relationship quite a bit. Basically, it reduced the economic output. We're selling overall less. And we're having less inflation, as a matter of fact. But it also caused a financial market response by the policymakers. An economic response to support the economy. We have expansionary fiscal policy to an extreme and expansionary monetary policy to an extreme. So we have a very different environment. The financial markets, instead of following the economy, are often a different path because companies are so radically affected radically in different ways. Hardly anything is the same. Basically, with the COVID, what we produce, how we produce it, how we deliver it, where we work, where we live, the entertainment we seek, etc. All of this has changed. And so basically we're having winners and losers of companies out there that either have a product that conforms with the constraints of the pandemic, or better still, are inventing new products to capitalize on it, which are the real winners in the financial markets. So instead of having a general overall view, movement of the overall economy in corresponds with the economy, now the overall movement of the financial markets is whether or not these companies have existing products that they can ramp up in this environment, or in the position with today's technology developing new products. And those are the especially juicy ones that we seek. So basically we're having a financial market response that's very different relative to the economy than one we generally get. But it also is a phenomenal opportunity for you as investors. That is, as long as you have an investment manager that is able to differentiate between the products that work and products that don't. Now, most investment management is done by firms where they're seeking to buy the market in some sense or the other, which means buy all sectors, buy all companies, more or less. And basically, what you're doing in that kind of plan of managing an investment portfolio is buying companies and sectors which are a mixture of winners and losers. At our end, we try to differentiate strongly, which is what sets us apart.
Well, I think part of that is that we're looking at a lot of companies that just their growth was coming anyway, but it was greatly accelerated. You have everything from the Skypes and Zooms and that type of interaction that many of you are probably using to communicate with kids and grandkids right now, and probably a year ago, very few of you had ever used either one of those things. There's a lot of things where you can sign documents via the internet now. There's all these touchless ways. Some of these things are not long for the world, but others are. They're with us now. They're going to be here for probably for a long, long time at least. That's everything, even things like medicine.
Yep. So what Frank and Dr. Spellman have been talking about really is the pandemic causing behavioral change. And what we're talking about here is the emergence of a remote economy that we think is going to persist even after the vaccines are approved and the therapies become even more effective. And it's behavior change by both workers and consumers. And for workers, what we foresee are nomad workers, a future of people splitting work between the office and home, and just like what's happening now. We think that's going to persist. And in fact, the CEO of Morgan Stanley, James Gorman, said that even after they returned to normal operations at the beginning of the year, only 50% of the workers at Morgan Stanley will operate from their offices in New York, from their tower. And the tech companies are saying much the same thing. Apple, Google, Microsoft, Amazon, Facebook, all of them look to keep their staff at remote locations for the foreseeable future, well into next year, and maybe beyond. In fact, Google has talked about keeping them there until at least mid next year. So all of this really has significant implications for computing, application software, the storage of data that reside in the cloud, either the public cloud, the private cloud. All of those applications and storage, that data must be easily and securely accessed by these remote workers. So all this implies increased demand for mobile devices, better laptops, tablets, the next generation of smartphones. We talk about that all the time. But beyond the workers, we can even add the nomad students into the mix, something that Dr. Spellman talks about regularly too, where students will split time between being on campus and being at home using these mobile devices. And as far as the consumer is concerned, remote retail is obviously firmly in place. Everyone using Amazon, buying from Amazon, but now consumers are becoming comfortable ordering on the web, picking it up at the curbside, the restaurant, groceries and food from their favorite restaurants. All that's becoming more commonplace.
You know, one other thing you mentioned Amazon is that I think that one thing that this has done, and it's counterintuitive, but I believe that it's actually worked in the favor of other online retailers, because people sitting at home have more time they look at Amazon and they see the price of something, and then they can search to find other places to buy that, and then it may end up buying it at Walmart.com or at Target or some other smaller retailer or such. But it may actually be helping
Other e-commerce
other
sites.
e-commerce
sites.
So we'll be keeping our eyes out for things like that. One other thing, backing up to the remote workers, I think it's going to be interesting to watch for opportunities in that area, because not just in people being remote, but does it continue to last at this pace? When you talk about 50% of the people of Google or of Morgan Stanley or someone being at home, people are basically social animals, and I think that we may see a little reversion to the mean in that over time. So I think that could end up being another area that the 30,000 foot view kind of regulates, is whether or not do we start at some point removing our investments from some areas and maybe favoring different ones as we watch to see what happens in that.
It is a very dynamic situation. So we've never been here before, so we've got to watch and track it very closely. And the thing is that the consumer is becoming increasingly comfortable with remote consumption of services too. Medical care, maybe you've had a telemedicine appointment, legal advice, using documents, signing legal documents and using the web to do that, investment advice, communicating like what we're doing now. So the consumer is getting much more comfortable consuming goods, but also services. And also, this is really increasing the demand for the Internet of Things, the connected devices. You probably have an Alexa in your home that you normally talk to, give commands or timers or ask questions of. Ratio, using your smartphone to control your sprinkler system at your house. Carrier has a Core app where you can control the air conditioners. Ring cameras around your house so you can watch what's going on securely. And all of these, while you're in or while you're here at the office, which we do. But all this means the remote workers, the remote students, the consumers, all this means an increased demand for bandwidth from the cellular networks. And luckily, 5G is just now coming, the 5th generation of cellular. And 5G is going to be, we talk about this all the time, 5G is going to be much faster than the current 4G LTE network. Engineers say that it's going to be between 10 and 100 times faster than what we use now, and with much better latency. And what this means, for an example, you'll be able to download a 2-hour movie in 7 seconds. Incredible speed. But it also has other very important implications, not just for autonomous driving that widely discussed in the news, but also for manufacturing and distribution, changing the way that products are built with robotics and real-time changes on the floor of a manufacturing operation. So 5G is so important that many see it as a crucial building block, really, for innovation and competitiveness over the next 10 to 15 years.
And it came online just at the right time.
Exactly. I mean, it is just fortuitous, right? This pandemic happened, and now we're getting 5G, and it's so important that Börje Ekholm, the CEO of the Swedish telecom equipment manufacturer Ericsson, said on a current conference call that the Europeans, 2 or 3 of the European countries were between 2 and 3 years behind on the 4G LTE network deployment, way behind us, way behind the Chinese. And he chided them because it's just not a network. It's not only the network, it's the applications that run on top of the network. And that's going to mean innovation and competitiveness. So it was quite something to hear him say that on a conference call, but that's how important 5G is to the future of the economy. And it's happening now in the US. You may have seen just last week that Verizon took the delivery of their first 5G base station from Ericsson, and it was produced in a factory in Lewiston, Texas, just north of north of Fort Worth, so a good win for the home team. And AT&T said last week that their 5G network is turning on across the U.S. So very important. And obviously the next thing you need are the handsets that are 5G enabled, and they're coming very soon before the end of the year. So this is all of these things, the Internet of Things, 5G, the mobile devices, all of that means a persistent demand for semiconductors, the chips that are inside these devices, the designers, the tools,
And software.
and the software, but all the semiconductors, the software, all of those things, the entire semiconductor food chain, if you will, showing very strong growth, likely to persist over the intermediate term. Now, beyond technology, which we spent a lot of time on, there are two other themes that we talked about being investable now. One is housing.
Sure.
And in response to the pandemic and increased crime, unrest, Frank's alluded to, higher taxes in the cities, there's a move out.
Yeah, there is, and we're seeing it for a multitude of reasons that more and more people are moving to the suburbs. Of course, we see it all the time, more and more people moving to Texas. This all kind of brings back to earlier when I said there's a Biden portfolio and a Trump portfolio, but going into the election, we're taking some of these themes and looking at both portfolios and say, well, where's the overlap? Because going into the election, we don't want to have a Trump or a Biden portfolio. We want to have a blend. What is the overlap? And make sure that, because there's a lot of things like 5G and cloud computing and even the housing. The interest rates are low and housing is affordable right now. There's lots of millennials that are ready to move out of the basement and into their parents' basement and into their own homes, and now they have an opportunity to do just that. So there's a lot of things that are going to work under either president.
You could say they're big secular trends, right? Regardless of party, regardless of president, these are big secular trends. They might accelerate or decelerate depending on the different things that could happen. But when we look at housing, one of the things that you may not see on the network news or on news is that new home sales are back above pre-pandemic levels. Amazing. So it's happening. And, finally, with all the changes in behavior, we've talked a lot about, what will happen after the pandemic. There will be companies that will be weakened, may not make it. There'll be likely a period of mergers and acquisitions. We've talked about that. Management consulting. So as the dust settles, the pieces get rearranged on the board. So, broadly speaking, we're talking about, 3-4 main areas: technology, housing, mergers and acquisitions, and consulting as themes that we're working on, and you're going to see those in your portfolio.
Yeah, that kind of leads also back to the 30,000-foot view and the fact that there are some sectors, like take banking, that are just completely out of favor. You'll not see any banks in your portfolio, and the simple reason is that right now the spread between what they borrow at and what they can loan at is so small with interest rates this low that they simply can't make any money, and especially the banks that are pure banks like a Wells Fargo or something. Some of them, JP Morgan Chase, well, they do have the JP Morgan part of brokerage, and then they have Chase part of banking, or Bank of America with Merrill Lynch, and then the traditional banking. But the traditional banking piece is such a lead weight right now that they're going to have quite a while. They're going to have a hard time making real money.
It's just an area that we think to avoid.
That's just one example. Why the index is not. The index was favored a lot coming out of the recession because it was a rising tide lifting all boats. But now it's a different scenario. We've got these super low interest rates. We've got some businesses that, especially where people congregate, the obvious ones like the cruise ships and the hotels, those are going to become good investments again. They just don't happen to be one today.
And even within hospitality, we could see that kind of splitting off where, business travel, because of all the investments they've made in technology, the mobile worker, we think that's likely to stay at a suppressed level versus before the pandemic. But the consumer, the leisure travel, likely to come back at some point.
Exactly. So it's going to favor some types of organizations over others, a Marriott versus someone who's strictly leisure. So we're going to see, obviously we're already seeing lots of change, and a lot of it's real obvious. We just kind of want to point out some of what we're thinking, so when you look at your portfolio and you've got a better understanding of why you own what you own.
And basically, we still have conventional fiscal and monetary policy overlooking this.
Yes.
And we have an election going on, and what it appears to be doing is generating a competition between the parties of who could spend the most and put the money in the pocket of their constituents. And at the same time, the Federal Reserve is extraordinarily accommodative, basically buying financial bonds, particularly in the first instance, putting the interest rates. The mortgage rate is the all-time low in the history of this country.
Which is one of the drivers for the
home building. Yeah. But moreover, it supports all asset prices. So we do have this iffy economy, let's say, but basically the financial markets are heavily supported when the central bank, yes, they focus on bonds, but they buy the bonds from an investment manager, and they now have the cash to buy something else. So basically it filters out to all assets. And it provides incredibly strong support for asset prices in financial markets.
Well, you add that and the fact that there's still $4 trillion in money market funds, that is going to, a lot of that will filter back into the economy at some point. But we still have about $2 trillion of the Fed's $3 trillion still there on the sidelines, ready to be used, and almost $1 trillion left from Congress' original package. So now they're talking about another $1 trillion to $3 trillion more. That's a lot of money between all those groups. So I think that what you're seeing a lot of is that the consumer has come back. Retail sales rebounded quickly because people may have lost their job, but they didn't lose their income. And in fact, in many, many cases, a huge percentage of the cases of low income especially, they are actually making more money today with the unemployment and the federal subsidy than they were while working. It's been kind of a point of contention in Washington, D.C. right now. But nevertheless, we're just dealing with reality, and the reality is there's plenty of money out there for consumers, and they're using it. You combine all that money that's out there along with what we've been talking about, these historically low interest rates, which have allowed businesses to refinance their debt at extremely low rates. We've seen many of the
a lot of tech companies with their convert deals.
Yeah, they're coming out with convertible
billion-dollar
convertible bonds at nothing, at less than 1% sometimes. 1%. And in the billions of dollars.
Haven't really ever seen that before.
No one's ever seen that before. So you put it all together, there's a lot of money that can still push the market forward, and along with the fact that we are reopening. We're reopening here in the United States. Yeah, we hit a hiccup in the reopening, but now it's starting to reopen again on a broader scale, and the hiccup was in certain locations, and while others continue to reopen, and the rest of the world is reopening. So that's going to provide further stimulus to the economy. Sure, we looked at the second quarter, GDP just came out. It was probably the worst since the Great Depression. No surprise to anyone, since pretty much everything was shut down. It wasn't an economic shutdown, it was a government shutdown of business. So GDP dropped 34% in the second quarter. We expect it's probably going to rise about 15% or so in the third, and probably rise again. I'm not going to make a guess as to what percentage in the fourth quarter at this point, but A lot of that depends on give me a vaccine or several vaccines and or some accepted treatments. There's lots of both out there. Lots of treatments that people swear by, doctors swear by, but and certainly if you test positive or think you have it, it's worth looking into those. You can even ask us. We watch those almost as much, it seems like, as we watch the market, because the markets are so dependent ultimately on getting past COVID. Bottom line is COVID-19 is going to end, whether through eradication or vaccine or treatment. But like I said, if someone tests positive, let's get treatment right away. Don't send a loved one or yourself home to wait for them to get sick. It's like we say around here, if an animal were to scratch your leg, hopefully your doctor wouldn't send you home and say, hey, if it turns gangrene, we'll come to the hospital. I'd like to go ahead and treat the scratch right now and with disinfectant or what have you. So the one thing I think we can safely say about prevention is there are 3 vitamins that are, I don't think I would get taken off of Twitter for saying this, but C, A, and D3 that are very good for building your immune system. Zinc is a great thing to add for any antiviral. It helps you against colds. I take all 3 of those vitamins and zinc every single day, and hope you will talk to your doctor about doing the same if you aren't already. From all of us at Beck Capital, stay safe, stay healthy, and do something to enjoy every day. Thank you for joining us, and we look forward to talking to you again soon.